All right, well, there's a lot to talk about this morning. So joining me now with more is Walker Williams, Chief Market Strategist at Lido Advisors, joining us from Vail, Colorado. Thank you so much, sir, for joining this morning. And let's start with trade, because that does seem to be having an effect on the markets this morning. What do you make of the president's latest comments on Truth Social?
Obviously there's a lot of noise with tariffs and trade and has been pretty consistent all this year. We anticipate more noise to happen. I think it's just causing a level of uncertainty in various aspects of the economy on what inputs costs are going to be, how demand is going to stabilize or go down. Another interesting data point came in this morning with personal consumption becoming very soft after strong data in March and April. It does tend to look like we're on the late part of an economic cycle, with trade being a complicating factor.
Interesting. Okay, so based on the data then, and where you see us in this economic cycle, what do the PCE numbers tell us this morning about this phase that we're in?
It tells us that we need to be very careful. Like, obviously, you see personal consumption going down. You see inflation trending to the Fed's long-term targets. We do anticipate, inflation to be a little bit more sticky here, depending on what happens with the tariffs and the posturing with that. I think it drives us back to the old adage, quality matters. You need to be looking at the market with the discipline of, what are these investments and companies doing? Do they have quality balance sheets? Do they have cash? What are the debt loads? Who has more financial flexibility here? And also, the U.S. consumer has been on a tailwind for the past 10 plus years. It is natural to have some sort of tailing off of that growth over the intermediate term going forward.
Okay, so let's talk about what it means for equities. I know you hit on it there a bit, Walker, just that people do need to be cautious, especially when it comes to individual names here. But we've seen the market rise dramatically since that 20% pullback that happened in a single day amid those highest of tensions between the U.S. and China. The S&P set to rise 6% on the month. We are just a few percentage points away from a record high. It seems like if we are perhaps heading for more of a pullback, that the market would reflect something different. What can you tell us?
Well, there's a couple things going on. You had a bunch of earning beats after the first quarter. But then there's also one key course of data to always look at is fund flows. You've seen institutions rebalance here. You've seen various levels of deleveraging happen in April rapidly. You've seen people come back to the market. I do have to call this out in the technology sector. There is a systematic long-term theme with artificial intelligence that is very interesting, and we're in early innings of that, which is garnering fund flows, yet we don't know what the true long-term impact on the economy is on those. But at the same time, valuation discipline. The market looks very expensive today on a price to forward earnings basis, especially as those companies had stronger earnings, they were very quick to throw out guidance. So we're sort of in this unique place with the economy where it's like, at the end of the day, the fundamentals work. Strong balance sheets, free cash flow, valuation discipline, and flexibility.
Yeah.
There are other headwinds out there. Debt costs are expected to go up. We're seeing various refinancing efforts coming in. We're seeing various reworks in the private credit markets. But I think you got to sort of treat this market like late cycle. Lean into quality, lean into investment themes that are very thematic and longer term, and watch out for things that are very dependent on the U.S. consumer. Obviously, today's data sort of reflects that it is slow.
What does this mean for the Fed? How do you think that it impacts its decisions on interest rates going forward?
Great question. I think the Fed is very dependent on jobs data. We see inflation coming right into what they expect over the long term. We're very watching what the jobs data says here, because that has been persistently strong going into this. And you see that, there's obviously contractions, but the jobs and unemployment data is within bounds. That's the next big important piece of data to come out to see what the Fed's reaction is, in our opinion.
And anything else, Walker, that's on your radar as we head into the weekend here?
The US dollar. I think, obviously we've come out of a period where international investing was definitely out of favor. The dollar weakness is definitely interesting. If you go back to April, you saw the dollar fall versus more developed market currencies. It has now transitioned to more of a broader currency basket, especially with emerging market companies. This does affect trade, to say the least. On a relative value basis, international is starting to look a little bit more attractive. It still depends on economic data, but at the end of the day, we got to see what's driving cash flows, and always risk management isn't a sum of the time thing, it's an all of the time thing. And this market sort of brings that back to the forefront.
All right, Walker Williams, Chief Market Strategist at Lido Advisors, joining us from Colorado this morning. Walker, thank you.
Thank you.